Tesla on a bit of a roller coaster after declining yesterday. It's actually up today, and all this, of course, with the electric vehicle maker reporting a 12% increase in third quarter revenue on Wednesday, following 2 consecutive periods of decline. My next guest, though, says Tesla stock is overvalued and investors should wait for a larger pullback. Let's bring in Seth Goldstein, senior equity analyst at Morningstar Research. Seth, thanks very much for joining us.
Thanks for having me on.
Tesla is Tesla, isn't it? It's one of those stocks people love, hate. What are you concerned about with it right now?
Well, when we look at Tesla, we see a couple things. First, if you look at the near-term outlook, and I think the reason why shares were down in aftermarket trading last night and early trading this morning is because the near-term outlook for Tesla's 2 largest businesses, automotive and selling the energy generation and storage batteries, it appears to be weakening over the next 12 months. We think there was a big pull forward in demand during Q3, which led to record deliveries, record sales. But I think that was many buyers wanting to buy an EV ahead of the U.S. EV tax credit expiration. And as that expires, we expect broader U.S. EV sales will decline. And as Tesla is the market leader, they're likely to be the most impacted over the next 12 months. Now, you also have an energy generation and storage tariff, which are hurting profits. And you have increased competition from battery makers like CATL. And I think this is going to reduce the growth rate of this business over the next several years. Now, if we look at the opposite side, though, there's market enthusiasm for Tesla's robotaxi product. That's what's led to the over 80% gain in shares from the 52-week low over the past several months. And I think that's why we're seeing shares rally today, because Elon Musk said on the call last night that we're seeing the end of the Tesla employee, the safety rider in the Austin testing market within the next few months. And that's a good sign that robotaxi testing is progressing well. It's a very bullish sign for that product, but we still think ultimately the stock is overvalued at the current price.
Okay, and who are, just going back, how much of a hit do you think they'll take with the EV tax credits gone, and who are some of the competitors for them? Who do they have to look out for?
Well, when we're looking at the auto industry, we see in the U.S. Sales declining in the fourth quarter for Tesla by a mid-single digit. We think we're likely to see a similar decline for 2026 deliveries as well. And I think we'll see growth in Europe. I think we'll see growth in markets like China that are very important to Tesla, offset by declining sales in the U.S. as we see the broader EV sales decline. And I think Tesla's not going to be the only one. We're going to see legacy automakers like a Ford, like a GM, see lower EV sales. A new upstart like Rivian is likely to see lower EV sales as well. And I think that's going to affect the entire market. But as Tesla's the market leader, they're going to be the most impacted.
And then on the positive side, we're talking about down in Austin that they've started to go completely driverless. How long are people going to be patient with this before they start raising questions, you think?
Well, I think we need to continue to see meaningful progress in testing. So removing the safety drivers is a big first step. Now I want to see them expand the geofence area or essentially remove it from the entire Austin metro area, maybe even include neighboring cities like San Antonio. So you can essentially mimic all of the ride-hailing distances that someone might take in an Uber or a Lyft today. And so I think once they do that, that's another positive sign that the robotaxi is ready to rival Waymo, who is currently operating a paid robotaxi service and is not just testing in the Austin area. And so once we see that, then the next step is to expand to more cities, and that would give us more confidence. But we don't think that's likely to happen by 2026. We think they'll progress through testing, and we point to more 2027, 2028 as when we see the full robotaxi launch in the U.S.
All right, and you touched on the energy generation, AI. Are you bullish on this, or bullish or bearish on those sectors?
Well, we're bullish on energy generation and storage. We think that batteries will be built all around the world, and we think this is going to be a strong mid-double-digit growth rate for the years to come, because you can get more capacity utilization out of your existing power generation. You can pair it with renewable energy generation to get more grid stability. And so we think this has a long-term runway. That being said, Tesla's going to start to run into plant capacity limitations and increased competition from a battery maker, CATL, which is the largest in the world, which can try to undercut Tesla on price. And so while I do think that there's going to be a strong growth rate industry-wide in battery deployments, that might not necessarily mean that Tesla can get the profits and free cash flow from that business.
All right, and you're saying that it's overvalued. Your price target is 300, sell territory. What would change that before we go? You got about 30 seconds, 45 seconds.
Well, the biggest thing I want to see is a robotaxi acceleration, and that would cause me to be more bullish and increase my forecast there. I'd also want to see progress on Optimus. I think that's a long-term story, but if that becomes in the next 2 or 3 years, then that would cause me to be more bullish, and Tesla could transition to AI and robotaxis.
Okay. Seth, thank you very much for joining us today.